It has finally happened. Warren Buffett has revealed his most recent moves in Berkshire Hathaway's quarterly 13F filing. These filings provide an inside look into how one of the world's most legendary investors is positioning his portfolio, and they often give hints about how he views the economy and financial markets in the months ahead. Buffett's latest trades don't just reflect his usual cautious and value-driven style. They also echo the warnings he shared earlier this year about long-term risks facing the U.S. economy, especially when it comes to government spending, debt, and the stability of the U.S. dollar. Back in May 2025, Buffett warned investors at Berkshire's annual meeting that fiscal policy in the United States, essentially how the government taxes, spends, and borrows, was his biggest concern. He made the point that governments, by their very nature, often move in the direction of making their currency less valuable over time. This, he suggested, is the natural course of excessive borrowing and spending. In other words, while the U.S. dollar has historically been trusted worldwide, Buffett believes that mounting debt and loose fiscal policy could erode that trust, leading to long-term challenges for investors. With that backdrop, it's not surprising that Buffett's recent trades show him quietly preparing for what could be a turbulent financial future. Let's break down what he's doing, what risks he's preparing for, and how regular investors might learn from his strategy. What Buffett has been selling. The most striking trend in Buffett's portfolio is that he continues to sell more than he buys. This marks the 11th straight quarter, nearly 3 years, where Berkshire Hathaway has reduced its stock holdings overall. Buffett trimmed his largest single holding, Apple, selling about $4.6 billion worth of shares, roughly 6% of Berkshire's position. Apple has long been one of Berkshire's crown jewels, so this reduction is notable. He also sold over $1 billion worth of Bank of America shares, reducing Berkshire's exposure to the financial sector. For decades, Buffett has favored large U.S. banks, but recently he has been steadily reducing those positions, signaling that he sees less opportunity or perhaps more risk there today. On top of that, Berkshire completely exited its position in T-Mobile, which had once been valued around $1 billion, and sold about half of its shares in Charter Communications. These moves reflect a clear trend. Buffett is locking in gains, reducing risk in industries he feels are more vulnerable, and building up Berkshire's already massive cash reserves. By the end of this quarter, Berkshire's pile of cash and treasury bills had reached levels not seen in the company's 60-year history. In fact, the company now holds more cash than at any point in its existence. This mountain of cash is no accident. Buffett has always said that opportunities come rarely in investing, and when they do, he wants to be ready with what he calls dry powder. His strategy is to wait patiently and act decisively when markets finally offer bargains. He has repeated this idea many times. When opportunities are scarce, it is better to do nothing and wait rather than chase investments at inflated prices. What Buffett has been buying. Although Berkshire sold more than it bought this quarter, Buffett did open several new positions. Each of them, while seemingly spread across different industries, shares certain traits that fit into a broader defensive strategy. Here are the 6 stocks Buffett purchased. Allegion, a company specializing in security products like locks and access systems. D.R. Horton, one of the largest home builders in the United States. Lamar Advertising, an outdoor advertising business that owns and operates billboards. Nucor, a steel manufacturer. Chevron. Buffett added another $450 million to this oil and gas giant, expanding a long-held energy bet. United Health Group, a major health insurance provider. At first glance, these companies may seem unrelated: housing, advertising, steel, oil, and healthcare. But Buffett's choices are rarely random. They all share a few common traits that make them valuable in the kind of economic environment he fears may be coming. Why these purchases make sense. Buffett's recent buys share 3 key features. They own tangible assets. These businesses are capital intensive, meaning they require factories, machinery, equipment, or land to operate. These physical assets tend to hold their value even in times of inflation. For example, a steel mill or a fleet of oil rigs doesn't lose value simply because the dollar weakens. If anything, the cost of replacing such assets rises when inflation takes hold, making existing assets more valuable. They generate strong cash flows. Each of these companies produces reliable, significant income. Free cash flow is the lifeblood of any business, but it becomes especially valuable in downturns or inflationary environments where external financing becomes more expensive. They are relatively cheap compared to the market. Buffett has long been a value investor, preferring to buy companies that are trading at a discount to their intrinsic worth. By focusing on businesses that are undervalued today, he not only avoids overpaying, but also positions himself for higher returns if the broader market eventually corrects downward. Inflation in tangible assets. A central theme in Buffett's recent positioning is protection against inflation and a weakening dollar. He has warned repeatedly that if the U.S. government borrows too much, eventually it may resort to printing money to meet its obligations. That scenario reduces the purchasing power of the dollar. Owning tangible assets like factories, steel-making equipment, or oil reserves can be a hedge against that risk. For example, if inflation reduces the dollar's value by half, the replacement cost of a steel plant could double. But if you already own that plant, its economic value has effectively risen without you doing anything. That's why Buffett prefers businesses built on real, hard assets rather than purely digital or speculative valuations. Studies back up this strategy. Historically, industries tied to real assets, like coal, oil, steel, and industrial equipment, have performed better during periods of high inflation. Quantitative research firms that simulate market conditions across millions of scenarios have found the same result. Companies with real, productive assets tend to hold up best when inflation runs high. United Health, a contrarian play. One of Buffett's largest new moves was a $1.6 billion investment in United Health Group. Unlike the other new additions, healthcare isn't an asset-heavy industry. But what made United Health attractive is the price. The company's stock had been beaten down before Berkshire's purchase, making it a classic value opportunity. When Buffett's investment was revealed, the stock surged 17%, showing just how much confidence his buying can inspire. United Health still fits into Buffett's broader rules. Even though it lacks heavy machinery or physical assets, it generates enormous free cash flow. That financial strength means it can weather downturns and continue rewarding shareholders regardless of economic turbulence. The risks Buffett is guarding against. So what risks does Buffett see ahead? His trades suggest two major concerns: excess borrowing and speculation inflating markets. Buffett has warned that too much leverage in the market creates unsustainable valuations. Over the past few decades, the amount of stock bought with borrowed money has consistently grown faster than the broader market. That means today's prices are supported in part by debt rather than purely by earnings and growth. If that debt unwinds, stock prices could tumble. A related concern is the growing concentration of the market in a handful of giant companies. Today, just 7 tech giants make up nearly 30% of the S&P 500's weight. When so much value is concentrated in so few companies, it leaves the market more vulnerable to sudden shocks. Rising U.S. government debt. The national debt has already surpassed the country's GDP and continues climbing. Ray Dalio, another well-known investor, has predicted that U.S. debt could reach $55 to $60 trillion within the next decade. Buffett has said that trust in U.S. institutions and the dollar's global reserve status has allowed the country to borrow so heavily up to this point. But trust has limits, and if confidence in the dollar erodes, inflation and devaluation could follow. Buffett's cathedral and casino metaphor. To wrap up, Buffett has described the U.S. economy in a way that perfectly captures today's situation. He compared it to a magnificent cathedral with a casino attached. The cathedral represents the real economy, the businesses producing real goods and services, creating jobs and driving long-term prosperity. The casino represents the stock market, where speculation, excitement, and fast money dominate the conversation. Both exist side by side. The danger, Buffett warns, is that the casino can overshadow the cathedral. Investors get caught up in short-term speculation, forgetting that the real foundation of wealth is productive business activity, not market hype. His message is clear: focus on the cathedral, on real value and avoid being distracted by the noise of the casino. Final thoughts. Warren Buffett's latest trades are more than just portfolio tweaks. They reveal a carefully thought-out playbook for navigating uncertain times. Hold cash, avoid overvalued growth, and lean into businesses with real assets and steady cash flow. These moves reflect his concerns about inflation, debt, and speculation in today's markets. For everyday investors, the lesson isn't to copy Buffett trade for trade, but to adopt the same principles: patience, discipline, and a focus on long-term value. By doing so, we can better prepare for whatever the next phase of the market brings.